expressing a desire to become a super app or digital one-stop destination for all financial planning, management needs. Who do you view as your closest comps in terms of mind share in this regard? And what differentiates SoFi? And tend to think in terms of right to win. What gives it the right to win in this market?
Sure. So today, there's no one that's a direct competitor. No one is offering the breadth of financial services products on a digital mobile platform like SoFi is. A lot of people talk about it. They talk about the aspiration to get there. They've talked about it since I've got here. No one has done it. We've been the only company that has done it, whether it's a neo bank or FinTech or a traditional legacy bank or payments company. A lot of talk, not a lot of substance. We've launched all the products. Not only have we launched the products, we're scaling them and we're producing profitable results with record revenue, and the strategy is playing itself out. I believe we compete today primarily with legacy FDIC banks. There's 500 million accounts in our country that are still tied to legacy FDIC banks, and our goal is to acquire every one of them. Obviously, a person could have multiple accounts. We want to acquire the people. We want to build trust and reliability with them, and then we want to continue to add products on top of that first relationship. We believe in the traditional legacy bank area, there is not someone that's offering the same suite of products that we are to their entire user base. There are some banks that do offer student loans, not a lot, very few. There are some banks that offer brokerage. They do offer brokerage. They don't offer it with the same level of selection that we have, with the same ease of use that we have, and the same information availability, and without minimums and without commissions, which basically is free. Many are not in the home loans business because it's been so hard to operate that, and given how regulated it is. And so banks have picked and choose what businesses they're in based on the best ROE. The reason why we architect all our products to be attractive by itself is so that we don't pick and choose based on what the best ROE is. We pick and choose what's most important to our members. Our right to win is that we are the only one-stop shop that you can use our products, and each one of them is better than a single product offered by somebody else. We're not all the way there yet on best in class, but we're pretty damn close. Let's take SoFi Invest as an example. What's our right to win for SoFi Invest? And let's be clear, we have to have each product have a right to win on its own, and then collectively show how our products are better when used together. But if they're not best to begin with, the rest of it won't work. And so we're moving to that process. But how do we compete in SoFi Invest? Why are we seeing such rapid growth if you look at our brokerage numbers as we report them? It's because we're the only place that you can go to buy single stocks without commissions, to buy fractional shares without commissions, to buy robo accounts without having to pay for them, or robo accounts at all for that matter. We've developed 6 SoFi branded ETFs that uniquely cater to our members based on the data that we see from them and their asks. And we also have over 30 cryptocurrencies, and we offer IPOs. We just offered the Rivian IPO, and there will be others. No one else is doing that. Robinhood's not doing that. E-Trade's not doing that. Any broker, Webull, traditional TD Waterhouse, no one else is doing that. That's just selection. Let's talk about fast. We make your funds available to you the day you open your account. We don't wait T+3 for you to transfer for the ACH. We instantly fund you. And if there's a limit on how much we instantly fund you, but we instantly fund you so you can quickly open an account and start buying stocks. Similarly, if you already have a SoFi Money account, you don't even have to transfer money. It's available for you to trade immediately without moving any of the money. And so that's fast. It's also convenient. We also have unique content that no one else has. So those variables, fast, selection, content, convenience, are what we differentiate on to give us a right to win. And then we make our products better when they work together. So think about SoFi Rewards. For those that don't use SoFi, we do have the traditional rewards program. You use your credit card, you get 1% back. But if you use your credit card and you earn points, we will double those points if you redeem them into SoFi Invest for cryptocurrency or fractional shares or robo or ETFs. We'll double them if you put it into SoFi Money, and we'll double them if you use it to make a payment on loans that you have with us. You not only earn points on SoFi for how often you use your credit card, we also give you points for making your life better financially. So direct deposit, we give you points. Recurring investments, we give you points. Coming to the app and reading articles, we give you points. And we'll continue to help our members achieve success by spending, the right way, by investing the right way, and educating themselves the right way. And so it's the totality of our value proposition where each product is great by itself, fast, great product features, et cetera, but they work better when you use them together. Rewards is one example of that. Personal loans, when you apply for a personal loan, we approve you with an interest rate. If you do direct deposit with us, that interest rate's even lower. And you'll continue to see these types of examples of our products working better together.
Got it. Aaron, you have some questions now.
Yeah, thanks. A key component of SoFi's plan is pursuing a bank charter application. You've articulated in the past why you're doing that, and so I feel like you only need a high level reiteration of that. But more importantly, as it relates to the process itself and the regulatory uncertainty, it may actually be worthwhile to review what you said on your recent earnings call about the tactical elements of the process, the timing, et cetera. And then I have a couple more questions on the bank charter.
Sure. We refiled in March with the change of control application after having received OCC preliminary conditional approval last October of 2020, when we had applied de novo. The process of the bank charter really involves a couple pieces. There's an exam piece in which the different functional areas of the bank and the bank holding company are examined by the OCC and the Federal Reserve. There's also the financial analysis piece. There's a governance piece. There's a permissibility piece. And we've gone through many elements of that. There's no defined timeline of when a decision is rendered, but we've made really good progress on the exam, and the feedback has been very constructive on both exams. You can look at our balance sheet and look at our capital ratios compared to other banks and what other banks are required. When we had preliminary conditional approval from the OCC, I think they awarded us a 9% leverage ratio. Obviously, the Federal Reserve hasn't weighed in on that yet, and it could change, and we haven't heard back since their change of control. But if you use 9 or 10 or even 11% for that matter, we're well above that, given the amount of capital we have in the balance sheet at $4.6 billion now relative to our assets. So that's pretty obvious for people to take a look at. And what you can't do is stress test it the way the Fed and the OCC will and FDIC relative to other shocks like 2008, but you can see that at a high level. Our governance, you have a view into that. We have no more preferred stock. That was a big issue we had to clear up. And we have a board both at the company level and at the bank level that's been constituted. Permissibility is ongoing, and that analysis is ongoing. There are obviously moving parts in Washington with the different regulators in terms of leadership, so that's another variable. So from a standpoint of what SoFi can do, we've provided all the information, we've gone through all the processes. The ball is really in the regulators' courts in terms of the last steps that are in the process, and it shouldn't be missed by anybody that there is leadership changes and that could impact timing. And so we're working with the regulators in a really constructive way and encouraged by the process up until this point.
Thanks. And when you get the bank charter, how do you envision growing the deposit base? Historically, online banks lead with high yield savings, and then they offer online checking products later. What do you expect your path to be?
Yeah, so we already have a pretty significant amount of deposits through SoFi Money. We can't use those for lending because we are not a bank. We do have FDIC insurance through our sweep program in those banks. So the first thing I'd say is we actually have a pretty substantial amount of deposits that can help fund our loans. And we also have a lot of our own equity capital that we're currently using. And so having the access to deposits will reduce even further our warehouse facility usage relative to it already being pretty low now, given the amount of capital that we have. We are going to have a value proposition in SoFi Money that drives to primary accounts. We want to have our account be their primary account because the information that we get on a daily basis helps us better recommend and personalize offers for our members and how they make their lives better financially. In order to get there, we think the formula is pretty straightforward. We think absolutely you have to have early paycheck. Today we offer 2-day early paycheck. I'd like to do even sooner. Second, free overdraft. No minimum balance, no minimum spending requirement, roundups, in addition to that, an interest rate. And I think there's an opportunity for us to do all the things that I mentioned, which we're doing today, and be more aggressive on the interest rate. When we launched SoFi Money originally, We launched with a 2.25% interest rate. I think Fed funds rates at the time was 2%. People were shocked and appalled that we would give 2.25% interest on an equivalent of a checking account with no minimum balance, no restriction on the cash. I'm not sure we'll be up at that rate, but we'll have a very competitive rate that would cause someone to say, why am I doing checking with anyone else? SoFi gives me the ability to pay from my phone, set up bill pay automatically, do electronic pay at the moment at any point in time, use a debit card, have physical checks sent on my behalf, do person-to-person payments, do budgeting, plus free overdraft, plus no fees, plus roundups, and I get my paycheck early. Oh, and I get a 1% interest rate, and I have no restriction on my cash when I get the 1% interest rate. Why would you go anyplace else? So, we think we can differentiate the product really meaningfully. The second thing we can do, because we'll have a lower cost of funds, is that we can lower the interest rates that we charge on our loans, which has a productivity loop to it, because the lower your rates are, the better the credit score that you get, and then there's more products and services that person needs. So we could also use our loans as a way to drive direct deposits. So for example, right now on personal loans, as I mentioned, we give you a rate without direct deposit and then an interest rate on that personal loan with direct deposit. Every one of our offers across the company should include a standalone price or standalone offering, and then a better offering if you do direct deposit with us. And so that could be in invest, that could be in crypto, that could be in loans, and obviously it could be in credit card as well. So we'll leverage all those different ways to be better together to drive direct deposit.
Thanks. The other aspect of that, and you were just touching on loans, most of the loans you have today are originated to sell versus hold on the balance sheet for the lifetime. Would you be able to share what your target would be for holding loans on balance sheet, as you grow in the future?
Yeah, I think what Chris has said in the past is that we will do a hybrid of gain on sale plus hold for investment. It'll be a transition. We'll likely on gain on sale move to from 90 days to probably 180 days in terms of average holding time period, because we have access to funding and we have access to multiple layers. We can hold the loans a little longer and then do gain on sale, because it drives more ROE on those loans by holding them another 3 months. The sale price and execution doesn't really change on gain on sale just because you hold for another 3 months. So we know that. So we want to be in the efficient frontier, so to speak, on gain on sale and optimizing the holding period. And then we will do some hold for investment, and we'll transition to the optimal mix between gain on sale and hold for investment over time to maximize returns, return on invested capital and return on equity. But we'll definitely use multi-factor approach.
Okay. And then switching to talent, attracting and retaining top-notch talent is not easy in the current environment. Could you speak to what your own experience has been and what SoFi is doing to ensure that you're adequately staffed for the growth that you envision?
Yeah, I mean, we've spent the better part of the last 4 years building our leadership team and bringing in great talent. And, we've had the same leadership team in place for the last year. We compensate people fairly. They all have large stakes in the company. You can see that in our filings. People have a lot of vested interest in driving shareholder value over the long term, not the near term. When we hire people, we give them 4-year equity grants. That equity is, priced at that time, not 4 years later. And so you have 4 years of equity when you join the company that will be increasing every day that you're at the company. Our equity value, fortunately, has gone up quite meaningfully in the last 4 years. I think it's up relative to the equity that we offered before we were public, about 3.5, almost 4x from where people got it. So because those people had a 4-year grant, they have really high holding value. Holding value is a key element in how people think about compensation and wealth creation. From a non-economic standpoint, from a more intangible standpoint, it's really critical that we allow people to achieve their personal and professional goals at SoFi. We have to have career development paths for them that give them additional challenges and opportunities to grow. And, we're doing that process repeatedly throughout the company. My direct reports, I require them every year to write out by hand their personal and professional goals, so I know what they are and I can help them achieve them at SoFi. we're growing so fast and have such a diversity of business across, traditional financial services products, our technology platform. And then obviously all the functional areas of expertise. There's an endless opportunity for growth at the company. And there's no reason someone needs to leave if they want to be in the financial services sector, if they want to be in the technology sector, or if they want to be in the consumer-oriented sector. So we've been pretty fortunate to be able to attract people from the best technology and financial companies in the world. And, the environment is a lot more heated for engineering talent as well as other talent. But now that we're public and the values that we have, it does put us in a better position than most people.
Good. And then, given your strategic intent, one of the central questions is whether you can, successfully scale in financial services. And you addressed this in one of the previous questions. But could you walk investors through this point on, I'd say, 3 counts? First is product roadmap, right? Second is demand generation, including cross-buying, but not limited to it. And third is from a risk management angle.
Sure. On the product roadmap standpoint, I'll probably say something that isn't that exciting, but it's incredibly impactful. One of our core values is that we want to learn, iterate, and innovate. And so innovation is a direct result of testing and learning, trying new features, new functions, different designs, different use of data, experimenting with pricing, experimenting with interest rates, combining 2 different products to drive a value proposition, changing the UI. So our team is tasked with iterating endlessly on fast selection, content, and convenience. Let's talk about selection for a second, because this will sound like it's just a horizontal point. It's not just a horizontal point. Selection is basically pricing, features, functionality, services. And there's an endless array, because our product is digital, of elements of selection. We could have a 1-year loan. We could have a 5-year loan. We could have a 3-year loan. We could have a variable rate loan. We could have a hybrid variable going to fixed. There's just an endless array of selection within Invest. I gave you some of our points of difference on selection. There's an endless array of robo-advisory accounts we could create. There's an endless array of ETFs that we could create. There are ways to integrate Invest into Relay, into Money, in an endless number of ways. So there's infinite permutations across selection. Fast. There's time involved. No one wants to wait in an ATM line. No one wants to wait at a teller. Similarly, they don't want to wait 3 days for their money. They don't want to open an account and not get approved instantly. They don't want to transfer money and it not go get there instantly. So there's an endless array on the fast. So each of our teams prioritize a product backlog, sprints, in an agile way that's going across fast selection, content, convenience, and better together. And that iteration over and over and over is what drives innovation. So I could tell you about big product launches, like we're going to launch a new credit card. I'm not saying that we're doing that, but that's an example of a mission that's gone through every year. In insurance as a principle, yes, at some point. Vertical and brand awareness. When someone needs a financial services product, they think of us first, they come to us first, and they never go someplace else for the foreseeable future as a standalone company without a bank or with a bank. In terms of the stadium, a lot of people ask the question. Last year wasn't a great year for the stadium. There weren't people in the stands. There wasn't a ton of media coverage. We didn't get a lot of free impressions. This year's been incredible. We've learned a lot from last year, and we've implemented this year, and it's had a compounding impact on everything else we do. There's nothing better than like on a Wednesday or Thursday after the second game at the stadium, when someone walks in, they're like, man, my numbers are going up. Well, our referrals are going up. Our new adoption in this area is going up. And everyone's looking around and saying, well, did you do the causal analysis? And everyone comes back and says, we did the analysis. We can't tie it to anything. I'm like, brand awareness is going higher. When brand awareness goes higher, you get more clicks on the ads that you send. You get more people exploring the opportunity when they see it on television. And it's the tide that lifts all boats. So I couldn't be happier with the decision, and it's having that type of impact of making its footprint bigger than its foot.
And the risk management angle?
Yeah, we are in the business of risk. And I say that to our chief risk officer, and they say that to our group business unit leaders for all of our businesses. We have first, second, third line of defenses. We have risk management dashboards. We have limits. We're doing incident reviews and retros when we have issues. From a credit standpoint, which is one element of risk, We like our credit box, relatively conservative, and those are products our members want. They clearly do. And
from trying to do core banking themselves?
So payment processing is at the core of Galileo's value proposition. And then on top of that payment processing sits APIs and functionality that people build into. And so the vast majority of Galileo's partners are using not just Galileo's payment processing, but the functionality tied into that payment processing and the events APIs to run their entire businesses. On the payment processing side, it's really hard to build. Like, you could talk to any financial services company, you can talk to any technologist. Payment processing takes years to build. Why? There's a learning curve to it. The actual technology and the connectivity, that's not the hard part. The hard part is, how do you integrate with every merchant? How do you integrate with banks? How do you integrate with the debit networks? How do you integrate with the ATM networks and the ACH? How do you do that? Well, there's a lot of different endpoints, and they all have different problems and different procedures that you have to solve. And that becomes the hard thing. And then how do you scale it? Who's going to go and switch someone that has 5 million active accounts? Who's going to try a brand new, payment processing? It would take years. Even if you built it yourself, it would take years. And if you think about, the resources are not, infinite, that comes at the cost of growth. That comes at the cost of innovation on the front end. So it just becomes one of those things that's very much like a data center. No one's building their own data centers today. Why? Because that comes at the cost of investing in all these other things. And the reliability of the third-party cloud data centers is great. The cost of the third-party data centers is great. The innovation of the infrastructure software is great. So the formula becomes this simple. Can Galileo create more value for its partners than they can create on their own or with somebody else? And the answer to that question is yes. And that's why people don't build it themselves. And then in terms of the competition, we're running like crazy to stay in front of them so that we're building more value for them. We think by owning both SoFi and Galileo under the SoFi Technologies umbrella, we have a customer that informs the service provider on what they need, helps them build their product roadmap, helps them build best-in-class products. There are products that SoFi has asked Galileo to build that Galileo's customers don't even know they need yet. Core banking, multi-products, multi-tenant, integrating machine learning into transaction fraud monitoring, rewards platforms that are truly platforms for third parties to tie into and offer redemption opportunities. So I love the combination of having both companies under the overall umbrella, and that just increases our ability to deliver on. Can Galileo create more value for a company than itself? Definitively, yes. And can it create more value versus the competition? Up until this point, absolutely. And it's on us to continue to expand that lead. It's secular tailwinds. There's absolutely a secular tailwind of more people wanting to invest and to invest more money in a variety of different products and services. There's also a tailwind of people needing a digital financial solution across all of their products. That was driven by the realization of COVID and the pandemic and forcing people to stay home. So if they're able to survive up until that point without a digital product, they need one now. So those are really two strong secular tailwinds. The third secular tailwind is that the regulators are more innovative and they're better.
Any last remarks just to tie things together, takeaways for our audience?
Yeah, I think the biggest thing that I would like to communicate is we've seen the commercialization of the direct-to-consumer technology industry unfold in e-commerce. We've seen it unfold in online travel. We've seen it unfold in media and in video. And it really, truly hasn't happened in consumer financial services. Yes, there are very big payment companies. And yes, there are very big, what I'd call small, medium merchant companies. But there isn't a big $100 billion, $200 billion, $1 trillion direct-to-consumer technology financial services company. And when I came to SoFi, I absolutely saw an opportunity to improve the value proposition in financial services for a specific cohort of members. And we're going to nail it with that target and those members. And then over time, we'll build out the concentric circles of everyone from there. But we're focused on that $1 trillion opportunity because there will be a $1 trillion direct-to-consumer financial company or legacy financial company if they figure it out. We want that to be SoFi. We think we've built the strategy to get there, the products to get there, the balance sheet to get there, the right governance to get there. And 2022 will be the first year where making progress on that is 100% up to us. We don't need a board approval for a change in our capital structure. Hopefully we'll be through all the regulatory changes and have a bank license. That's still uncertain, obviously, but we've made good progress there. We have the capital on our balance sheet that we need. We have the team we need. We have the infrastructure and the products. So I'd love to invest at a faster rate than 70-30. I think that's a good balance to prove to the world that we can drive returns, and maybe we get the license to do more, but that's what we're investing in. That's where we're going, because I've seen it happen in all these other industries. I know the formula to make it happen, and we have that formula.
Great. Thank you very much.
Thank you, guys.
Thanks.
Take care.
Thanks, Anthony.